Hey everyone, welcome back to The Explainer. I am absolutely thrilled to have you here today because, wow, we have got a truly fascinating corporate earnings report to unpack. If you've been following the hyper-competitive coffee market in Asia, you already know it is an absolute battleground out there. Well, today we're taking a highly focused look at Tim's China and their Q1 2026 financial results. We're going to decode a massive strategic pivot that honestly has some incredibly counterintuitive numbers attached to it. Now, before we get completely lost in the spreadsheets and all the dense accounting metrics, let's take a second to anchor ourselves to what this business is actually doing on the ground. We're talking about the iconic Canadian brand Tim Hortons, famous for double doubles and Timbits, now fighting tooth and nail for dominance in the massive, hyper-tech Chinese consumer market. And the business behind these familiar coffees, donuts, and warm sandwiches, it's currently undergoing a structural earthquake. They are literally re-engineering how they operate, where they operate, and who they are selling to. And that brings us right to this central mystery of today's explainer. Think about this. How exactly does a major international coffee chain experience a 14.6% drop in revenue, but at the exact same time add over 10 million brand new registered loyalty members compared to the same time last year? It sounds like a total paradox, right? Normally, fewer sales mean fewer customers, but here the customer base is absolutely exploding while the top-line cash is shrinking. Okay, let's dive into this. Here is our roadmap to solve the mystery. We're going to look at the Q1 2026 financial snapshot, then their strategy for pruning the store network, followed by the loyalty silver lining, a breakdown of the costs, and finally, this new $55 million lifeline. All right, starting off with Section 1, the Q1 2026 financial snapshot, or what I like to call the top-line paradox. So looking at the raw top-line numbers, they paint a pretty tough picture. Total revenues for the first quarter of 2026 landed at 256.7 million RMB. When you compare that to the 300.7 million RMB they pulled in during the same quarter back in 2025, that is a stark 14.6% year-over-year decrease. And we saw a very similar trend in system-wide sales, which tracks the overall gross merchandise value, including franchise stores. That took a 14.2% dip down to 322.9 million RMB. Honestly, if you only looked at the top-line revenue right here, you'd probably just assume the brand is losing its audience. Now, what's really interesting about this slide is the twist. 35.9 million. That is the total number of registered loyalty club members Tim's China was sitting on at the end of Q1 2026. That represents a staggering 42.9% year-over-year surge. So no, they aren't losing relevance at all. They are actually accumulating a massive, highly engaged digital audience faster than ever. So why the revenue drop? To answer that, we move right into Section 2, pruning the store network. Quality over quantity. This is where we see the intentional strategy behind those falling numbers. You see, this drop in revenue wasn't an accident. CEO Yang Chenlu said it explicitly, quoting here, "In the first quarter, we continued our strategic adjustment to prune underperforming stores. This tells us the revenue drop was, in large part, a deliberate surgical move by management. They basically decided that maintaining unprofitable physical locations just for the sake of artificially propping up total revenue was a losing game. They're prioritizing unit economics, meaning the actual profitability of each individual store over sheer quantity." Let's break down that physical footprint for a second. They had a total net closure of 21 stores this quarter, but the really crucial detail here is where those closures actually happened. They only saw a net closure of 5 made-to-order or MTO stores. Those are the larger, more traditional cafes. Contrast that with 16 net closures of non-MTO stores, which heavily includes their smaller Tim's Express formats. So they are specifically trimming the fat on those smaller, hastily expanded formats that just simply weren't delivering the right profit margins. Which brings us to Section 3, the loyalty silver lining, digital dominance, and brand momentum. With fewer physical stores open, how exactly is the brand surviving? Check this out. 87.5%. That is the massive share of all orders at Tim's China that are now entirely digital, meaning delivery or mobile order for pickup. This completely contextualizes the store closures we just talked about. I mean, when almost 9 out of 10 customers are interacting with your brand through a smartphone screen rather than a physical cash register, the actual physical location of your store becomes slightly less critical than your digital infrastructure and your delivery logistics. And this brilliantly illustrates how you keep a growing base of nearly 36 million members engaged. You can't just be a coffee app, right? You really have to be a lifestyle brand. For their 7th anniversary, Tim's China launched this huge Maple Journey partnership with Air Canada, actually offering flight tickets to members. They also expanded their cultural IP collaborations with popular dramas, releasing themed merchandise. They are essentially using this giant digital loyalty base as an entertainment and lifestyle hub, and that keeps the brand top of mind, even if a physical store down your street happened to close. All right, let's get into the hard financial realities in Section 4, breaking down the costs. Narrowing expenses, but a widening loss. We're going to translate some dense accounting into plain English here. Now, while digital engagement is fantastic, it obviously has to translate to the bottom line eventually. And what we're seeing here is a classic sandwich effect in their expenses. Thanks to having fewer stores and really optimizing their supply chain, they successfully slashed their food and packaging costs by nearly 24%. Awesome! They also aggressively cut marketing expenses by a massive 43.7%. However, delivery costs actually crept up by 1% to 27.3 million RMB. Why? Because as they push digital, delivery volume is just surging. They fulfilled 4.9 million delivery orders this quarter alone. So they're saving money on the physical store side for sure, but they're paying for it on the logistics side. So the crucial point is, how does this all actually net out? Well, thanks to all that aggressive cost cutting, their actual operating loss improved, shrinking from 85.3 million RMB last year down to 72.3 million this quarter. So operationally, the bleeding slowed. However, their overall net loss widened significantly to 109.3 million RMB. That disconnect was driven heavily by non-cash expenses, specifically a 32.6 million RMB hit from changes in the fair value of their convertible notes. In plain English, that's just an accounting adjustment tied to their debt, not their daily coffee sales. Still, it's a stark reality, especially with their company-owned store contribution margin squeezing all the way down to just 1.8%. So with margins running that thin, how do they keep the lights on? Let's hit Section 5, the $55 million lifeline, fueling the future. Right alongside this earnings report, CFO Dong Li announced a massive financial catalyst. Tim's China entered into a definitive agreement for up to $55 million in additional senior secured convertible notes directly from the brand owner, THRI. Guys, this is absolutely pivotal. It represents a massive internal rescue and a huge vote of confidence from the parent brand, providing an immediate injection of capital designed to fortify their balance sheet and fund that resumption of nationwide expansion they've been promising starting in Q2. Which leaves us with the ultimate question to ponder as we wrap up. Tim's China has deliberately shrunk its physical footprint to stop the operational bleeding. They've built an absolute juggernaut of a digital loyalty program with nearly 36 million members. And now they are armed with $55 million in fresh capital. So, are they finally brewed for sustainable profitability, ready to fully leverage that massive digital base? Or is this capital injection just buying them a little more time in a coffee market that grows more fiercely competitive by the day? It is a fascinating business case, and I highly recommend keeping a close eye on their Q2 results to see which way the pendulum swings. Thank you so much for learning with me today on this explainer. Keep analyzing, and I'll see you next time.